Hi, I'm Ryan Geik, Senior Investment Consultant with Vanguard's Portfolio Analytics and Consulting team. Every year, we have the privilege of reviewing over 2,000 investment portfolios utilized by financial advisors and investment professionals within their businesses. These portfolios are provided to us from advisors in the RIA, bank and institutional, and broker-dealer client channel segments at Vanguard. Every 6 months, we put together our semi-annual and year-end Advisor Portfolio Construction Trends and Insights report. We find this information is helpful to advisors to understand where they sit with respect to their exposures relative to their peers, give them confidence and clarity in their investment allocation decisions, as well as pick up on any trends being utilized by the advisors our service works with. We're excited to bring to you our 2025 year-end update to Advisor Portfolio Construction Trends and Insights. One of the key themes in our 2025 year-end update is the usage of active and passive management styles across an advisor's multi-asset allocation. In 2025, we reviewed over 1,800 unique equity sleeves from advisors and 2,000 unique fixed income sleeves from the financial advisor community. In reviewing those, the message is clear. Advisors have a strong preference for passive management within equities, and conversely, hold a strong preference for active management across fixed income allocations. To put some numbers around that, for 2025, the median allocation to active management within equities was 32%, with 68% compositionally being passive in terms of their management style use. Within fixed income, the opposite was true. Roughly 79% was the median active fixed income allocation across those sleeves we reviewed, with the remaining 21% being passive in terms of its management style preference. Said differently, 1 in every 4 portfolios in the distribution of fixed income allocations we looked at in 2025 was entirely active with its management style. The message is clear. Advisors have a strong preference for active management within fixed income. And in a moment, my colleague Adam Herdel is going to walk through some of the implications of those active preferences across the fixed income allocations.
Thanks, Ryan. The rapid rise in inflation and interest rates during 2022 and 2023 did a lot to damage the reputation of bonds as ballast to total portfolio returns. Looking forward, that rise in interest rates now enables greater opportunity for investors to achieve different outcomes from their mix of fixed income investments. Capital preservation, risk diversification, total return, and higher income are all objectives that investors can achieve based on how they allocate across the curve and fixed income sectors. 2025 saw strong returns from bonds on the back of 3 rate cuts from the US Federal Reserve, with credit spreads ending the year where they started. That was despite the volatility associated with April's tariff announcements. The Bloomberg US Aggregate Bond Index finished the year up 7.3%, its highest annual return since 2020. Despite the changing fixed income environment, what remains the same is allocator preferences for actively managed strategies. Whilst the difference between 2-year and 10-year Treasury yields rose throughout 2025, duration positions remain short relative to the benchmark. The median duration we observed across 2,000 fixed income portfolios was 4.9 years, lower than the 5.8 years of the Bloomberg US Aggregate Float Adjusted Index. Preferences for active management also led to portfolios investing into high-yield bonds. Whilst exposure to high-yield bonds increased 0.5% to 10% of the fixed income allocation, there was a distinct gap between portfolios that had high usage of active strategies versus those that had less usage. As with our 2025 mid-year report, we distinguish between high-active and low-active portfolios. That is, when we rank all the fixed income portfolios from their highest allocation to active strategies to lowest, the top 50% of portfolios were categorized as high active, with the lowest 50% categorized as low active. In high active portfolios, over 14% of the fixed income allocation was exposed to high yield bonds, where the exposure in low active portfolios was only 5.5%. Now, this relationship also extends to fixed income sectors. When we look at exposures to taxable bonds in aggregate, relationships broadly remain the same from 2024 to 2025. That is, an underweight to government bonds with overweights to corporate bonds and cash and derivatives. However, when we examine those exposures in the context of high active and low active portfolios, it was very clear that a greater preference for active management creates a more significant underweight to government bonds. That median underweight was 30% versus low active portfolios where the median underweight was only 13%. Active strategies have demonstrated a history of overweighting corporate and securitized bonds as a way to increase portfolio yields and benefit from taking on additional credit risk. This is particularly true when we look at the median exposures to securitized bonds across high active and low active portfolios. These exposures highlight the importance of allocators understanding the objectives they want to achieve with fixed income and the level of risk they need to take to get there. Finally, we noted earlier that despite the high allocations made to active fixed income strategies, there are categories that passive strategies are more often used. This highlights ways in which active and passive management can be combined to ensure your bond portfolios are achieving the appropriate objectives for your clients. For more insights into what Vanguard is seeing in portfolio construction, please visit our website to download the full report. If you would like your own portfolio analysis to better understand what is driving client outcomes, please contact your Vanguard sales executive to find out how.